Just, you hit the nail on the head when you said it's a little bit noisy here. I mean, these orders and these shipment numbers are a little bit noisy, but in general, when you look at the first quarter, I mean, the shipment numbers will feed into that. I mean, we are looking for relatively slow investment spending, in the first quarter, somewhere on the order of 1, maybe 2% at an annualized pace. But those numbers that Rick were talking about, the core part of the durable goods orders, that's a strong number, and that's an encouraging sign.
And what is your forecast for first quarter GDP, and what is the trend right now for 2019?
So for the first quarter, we're looking for a 2.6% annualized number, and then if you look at for 2019, we think it's probably going to settle out somewhere around there, somewhere around 2.5 sort of percent. So that's down from the 2.9% that we grew last year, but still, a 2.5% number in 2019. If that's where it comes out to be, that's not a bad number at all.
So you don't think that a stronger than now forecast first quarter is simply pulling forward from the second?
Well, there's a little bit of that. What we do note is that if some of the shipments that Boeing is going to be making, so those things are going to weaken us up a little bit in the second quarter. But in terms of consumer spending, the good news there on consumer spending, we ended the first quarter on a very, very positive note. And so as we go into the second quarter, we think we're looking at a pretty decent pretty decent number there in terms of consumer spending as well.
And if you're right, if we grow more than 2.5% in the U.S. this year, is that compatible with the Federal Reserve being content to remain sidelined all year?
I think the hurdle for the Fed to hike rates this year, I think, is still pretty high. What they really need to see, we could have a 2.5%, we could have a 3% sort of number this year. But unless you start to see the core rate of inflation start to go up above 2%, on its way to even 2.5%, I think the Fed is content at this point to remain on the sidelines. It's really hard to make a convincing case at this point why they should be raising rates if you're looking at an inflation rate that's still at or even in some cases below what their target rate is.
And so does that mean you think the bond market has it roughly right here in terms of where Treasury yields are sitting?
I think so. I mean, I could see some upward, tilt to bond markets to the 10-year rate, kind of as you go forward here. I mean, what the bond market is looking for is actually a cut later on or in 2020. And if the Fed actually is on hold for most of this year, I think some of that cut will get priced out, and you will see bond yields start to move a little bit higher here. But I wouldn't expect them to go rocketing higher, as long as the Fed remains on the sidelines.
So about 1/3% of the way through this year, the question coming into 2019, of course, was how much more is left in this cycle? What's your latest thinking on that?
I think there's a lot left in this cycle. I mean, you have to ask yourself, how do recessions happen? They happen one of two ways. One is something unexpected happens, like an OPEC oil shock. And those things obviously can occur any time, but they're very difficult to forecast. The other way you get a recession is when something gets out of balance, like the housing market, or go back 20 years ago, tech. And when you look around the economy today, you say, what's wildly out of balance? There's nothing that's wildly out of balance at this point. So I think this cycle still has some legs to run.